A 1031 exchange can be done with a related party, but the IRS treats it like a red flag transaction. The big trap is what happens after the exchange. If either party disposes of the property too soon, the IRS can unwind the deal and force recognition of the deferred gain. On the EA exam, they test this as a timing rule, not a like-kind rule. So who counts as a related person? Think close family and controlled entities. Family includes your spouse, siblings, parents, and children. Then add entities you control, a corporation or partnership where you own more than 50%. Exam tip: they love more than 50%, not 50% or more. That small wording change matters. Here's the core rule. After a related party 1031 exchange, both parties must hold the property they received for 2 years. If either party disposes of it within that 2-year window, the original exchange is disqualified. That means the deferred gain from the original exchange gets recognized in the year of the early disposition. It's basically a retroactive nice try. When the rule is violated, don't overthink the mechanics. You're not redoing the whole exchange. You're simply pulling the deferred gain back into income. And it's recognized when the disposition happens, not when the exchange happened. On exam questions, watch the dates. The trigger is the sale or transfer within 2 years by either party. There are 3 big exceptions you need to memorize. 1. If one of the parties dies before the 2 years are up, the rule doesn't apply. 2. If there's an involuntary conversion like destruction or condemnation, the rule doesn't apply. 3. If you can prove to the IRS the exchange and later disposition weren't mainly for tax avoidance. That last one is facts and circumstances, so it's the hardest to rely on. Finally, paperwork. A related party 1031 exchange creates an ongoing reporting requirement. You file Form 8824 for the year of the exchange, and you also file Form 8824 for the next 2 years to show the IRS whether the 2-year holding rule was met. On the EA exam, if they mention related parties, your brain should immediately jump to 2-year rule plus 2 more years of Form 8824. Raphael owns a van used only in his airport shuttle business. The van is totaled. Its adjusted basis is $28,000. Insurance pays him $45,000. 1 week later, he replaces the van and he pays an extra $4,000 out of pocket. What is Raphael's basis in the new van, and how much of this is taxable? Think about it. The correct answer is $32,000 basis and 0 taxable gain. This is an involuntary conversion of business property, and he reinvested the proceeds in qualifying replacement property. So the new basis is the old adjusted basis, $28,000, plus the extra $4,000 he paid. A tempting wrong answer is $45,000 basis, because people confuse cost with carryover basis rules. Marisol owns a duplex. She lives in one half and rents the other. The government condemns the property, and she receives a $90,000 settlement. She paid $75,000 and made $15,000 of improvements split evenly. She took $20,000 of depreciation on the rental half and paid $2,000 in legal fees. She does not buy replacement property. What taxable gain or loss does she report? Think about it. The correct answer is taxable gain of $19,000. Treat the duplex as 2 properties. Split the award and legal fees. Each half has $44,000 net proceeds. Each half's cost basis is $45,000, but the rental half is reduced by $20,000 depreciation, so its adjusted basis is $25,000. $44,000 minus $25,000 equals $19,000 gain. The tempting wrong answer is 0. Forgetting depreciation reduces basis.